Land is often seen as a surefire investment, but this belief doesn't always hold true. By the end of this video, you'll understand why I call this notion nonsensical and how it may not be the best decision for everyone. I'll also explain how not buying land has actually saved me a lot of money, allowing me to purchase land anywhere at any time. Stick around until the end to learn more. When considering purchasing land, there are 5 key factors you must evaluate. Each of these factors should be considered individually and in conjunction with one another to determine if buying land is the right decision for you. Ignoring even one of these factors can lead to a disastrous investment. The first factor is the appreciation potential of the land. It's a common belief that land never depreciates, but this isn't entirely true. In rare cases, land can lose value due to natural disasters, pollution, or other unforeseen events. Generally, however, land tends to appreciate over time, often by 5 to 10% per year. In some cases, if a significant development occurs, such as the discovery of a valuable resource or infrastructure improvements, the value can increase rapidly. However, it's important to remember that inflation can impact this appreciation. If inflation exceeds the appreciation rate of your land, you could effectively be losing money. The second factor is financing. Most people don't have the means to buy land outright and must consider options like using their salary, savings, or taking out a bank loan. Bank loans, while common, come with interest rates that can sometimes be as high as 15 to 20%. If your land is appreciating at 10% but you're paying 15% interest, you're losing money. Additionally, using a significant portion of your salary to repay a loan limits your ability to invest in other opportunities. This brings us to the third factor, the development potential of the land. Simply buying land without developing it doesn't make financial sense unless you have excess funds and no other investment opportunities. Money should be used to generate more money. If you're not planning to develop the land into something profitable like apartments or a farm, it's not a wise investment. Opportunity cost, the fourth factor, is critical. Every dollar spent on land could be used elsewhere, potentially generating more immediate returns. For instance, starting a business might seem riskier, but it can provide significant cash flow and opportunities. Unlike land, which may take years to appreciate, a successful business can generate ongoing income and provide funds for future investments, including land. Finally, consider your risk tolerance. Those who are risk-averse, often older individuals who have accumulated savings over time, may prefer the perceived stability of land. However, younger individuals with more time to recover from potential losses might benefit more from taking calculated risks, such as starting a business. It's essential to recognize that while avoiding risk might seem prudent, it often limits your opportunities for substantial growth. In conclusion, while buying land can be a good investment for some, it's not a one-size-fits-all solution. It ties up capital that could be used for more immediate and potentially lucrative opportunities. Having a steady cash flow from a business or other investments provides flexibility and the ability to seize opportunities as they arise. Consider your circumstances, risk tolerance, and long-term goals carefully before deciding to invest in land. If you're looking to grow and excel financially, diversifying your investments and focusing on generating cash flow might be a better strategy. Why you should not buy lands investment in Africa. Investing in lands, assuming this refers to a specific company or investment project, in Africa might be discouraged for several reasons. Here are some potential considerations. 1. Political and economic instability. Many African countries face political and economic instability. This includes frequent changes in government, corruption, and weak legal frameworks, which can make investments risky and unpredictable. 2. Regulatory and legal risks. The regulatory environment in some African countries can be complex and subject to sudden changes. Investors might face challenges such as unclear property rights, bureaucratic hurdles, and unpredictable regulatory enforcement. 3. Infrastructure challenges. Many parts of Africa lack adequate infrastructure, including reliable transportation, energy, and communication networks. This can increase the cost and complexity of doing business, impacting the profitability of investments. 4. Market volatility. African markets can be highly volatile due to various factors, including commodity price fluctuations, currency instability, and varying levels of demand. This can make it difficult to achieve consistent returns. 5. Security concerns. Some regions in Africa face significant security issues, including terrorism, armed conflicts, and high crime rates. These can pose direct risks to assets and personnel, as well as disrupt business operations. 6. Limited access to financing. Access to capital can be a challenge in Africa. Local financial markets may be underdeveloped, and foreign investors might find it difficult to secure necessary funding or face high borrowing costs. 7. Environmental and social issues. Investments in Africa may be subject to scrutiny regarding their environmental and social impact. Projects that negatively affect local communities or the environment can face opposition, legal challenges, and damage to reputation. 8. Cultural and operational differences. Cultural and operational differences can pose challenges for foreign investors. Misunderstandings and misalignments in business practices, labor relations, and management styles can affect the success of investments. 9. Lack of transparency. Transparency issues, including limited availability of reliable data and financial information, can make it difficult to perform due diligence and accurately assess investment opportunities. 10. Competition and market saturation. In some sectors, particularly those that have seen significant foreign investment, competition can be intense, and market saturation can limit growth opportunities and profitability. Conclusion. While there are certainly opportunities for investment in Africa, it is important to carefully evaluate the specific risks and challenges associated with any particular investment, such as lands. Conducting thorough due diligence, seeking local expertise, and considering a diversified investment approach can help mitigate land business. Investing in empty land as a business can be appealing, but it comes with several risks and challenges. Here are some reasons why it might not be the best investment decision. 1. Lack of immediate income. Empty land does not generate immediate income. Unlike rental properties or dividend-paying stocks, land does not provide a regular cash flow, which can make it a less attractive investment for those seeking immediate returns. 2. High holding costs. Owning land involves various holding costs such as property taxes, insurance, and maintenance. These costs can add up over time and reduce the overall return on investment, especially if the land remains undeveloped for an extended period. 3. Market volatility and uncertainty. The value of land can be highly volatile and influenced by factors such as changes in zoning laws, local economic conditions, and market demand. Predicting future land values can be challenging, making it a potentially risky investment. 4. Zoning and regulatory issues. Land use is heavily regulated, and changes in zoning laws or land use regulations can significantly impact the value and utility of the land. These regulatory hurdles can complicate development plans and increase costs. 5. Development challenges. Developing land into a profitable venture requires substantial capital investment, expertise, and time. Issues such as securing permits, finding reliable contractors, and managing construction projects can be complex and time-consuming. 6. Limited liquidity. Land is a relatively illiquid asset compared to stocks or bonds. Selling land can take a considerable amount of time, and there is no guarantee of finding a buyer at the desired price. This lack of liquidity can be a drawback for investors needing quick access to cash. 7. Economic and environmental risks. Land investments can be susceptible to economic downturns and environmental risks such as natural disasters, contamination, or adverse weather conditions. These risks can negatively impact the value and usability of the land. 8. Financing difficulties. Securing financing for land purchases can be more challenging than for other types of real estate. Lenders may view land as a higher-risk investment and offer less favorable loan terms or require larger down payments. 9. Opportunity cost. Investing in empty land ties up capital that could be used for other potentially more profitable investments. The opportunity cost of investing in land should be considered, especially if there are other investments with better short-term returns. 10. Market saturation. In some areas, the market for land can be saturated, making it difficult to find buyers or tenants for developed properties. This can limit the potential for profit and make it harder to achieve a good return on investment. Conclusion. While buying empty land can offer potential long-term benefits, such as appreciation in value or development opportunities, it comes with significant risks and challenges. Careful consideration, thorough due diligence, and a clear understanding of the local market and regulatory environment are essential before making such an investment. Diversifying investments and consulting with real estate experts can also help mitigate some of these risks.